Hello and welcome back to Equity, TechCrunch's venture capital focused podcast where we unpack the numbers behind the headlines. My name is Alex Wilhelm and I am joined today by two of my favorite people, including Natasha Mascarenhas, one of our early stage venture capital reporters. Natasha, how are you doing?
I'm feeling great. Thank you to everyone also who left us a kind review recently. That was amazing and cheered up my day.
Oh yeah, no pressure to do that, but we did really appreciate it. And now turning to the source of all of our bad reviews, we have Danny Crichton, one of TC's.
Say, what is this concept of good reviews? Because I think a 2-star is pretty damn good for me.
Stop relating your middle school transcript to the show, Danny. They're different things. Anyways, Danny is one of our Danny's one of our managing editors here at TC, so if something isn't well managed, it's his fault. And I'm excited about today's show for a couple of reasons. One, we have a ton of great stuff, just a lot of really interesting things to go through. And also, it's my last show for a little bit. I will be off next week, and so into the capable hands of the rest of the team, Equity shall rest. And I will return with grades for everyone on their performance. But on the subject of education, there's new tools out there in the Zoom world for teachers, Natasha, and what is going on there?
Yeah, so the former co-founder of Blackboard, which is a learning system that I don't know if you guys used in college. I used it to check grades and syllabi. You don't like it, Alex.
It's terrible.
Alex is just putting 2 thumbs down on the Siskel and Eckel version of software ratings.
I mean, guys, Blackboard was notoriously bad even like 10 years ago. I can't imagine it's gotten better.
Well, thankfully, the co-founder has, he went to actually Precision Hawk, which is a drone startup, left that in January, is now onto his new company, ClassEDU. And their first product is not so casually called Class for Zoom. For everyone listening, I suggest reading my story because the demo does a really good job and I won't be able to do it as great of a job. But the features are basically creating a Zoom if it was genuinely built for teachers to lead a class beyond kind of a one-on-one discussion, which is kind of how Zoom is right now. So some of the features, I'll run through them really quickly, is a teacher can kind of launch live assignments, quizzes, and tests. Then it can see students complete them while also seeing their desktop view. You have to give permission, but in some way it's like proctoring. And we can debate on if that's too much power or not. It can also kind of unmute a class or mute a class, which is good for early learners. It can, its structure kind of puts the teacher on the left and lets students toggle between different views of the TA, friends, assignments they're talking about. And then finally, it lets students kind of break out and ask a teacher a question while staying in the Zoom call. It can kind of do a one-on-one Zoom with them on the side to ask questions in case they're shy and don't want to talk in front of a whole class. So those are some of the big features.
I feel like the modern teacher is becoming like a DJ. They've got to have like 4 records spinning at all times. They've got to be like roaring in the crowd. I mean, this is intense. Like, to me, the only thing I need in a classroom is a mute button to shut everyone up so that you can just lecture for an hour straight.
That's why, Danny, I think you'd be a great professor at the graduate level, but I think you'd be a trash 5th grade leader. Natasha, I have a question about the software itself. So is this kind of a sidecar to kind of the Zoom software that we know and use and honestly like? Or is this an entire separate video chatting service as well as software for teachers to also interact more with the students?
Yeah, so I think it's complicated by design, and I have a feeling that ClassEDU knows something we don't about Zoom's appetite for acquisition, because it just seems like the startup is pitching itself to be acquired. Right now, to answer your question, it is layered on top of Zoom. Zoom's SDK is $0. And so free, easy to access, and developers are building on top of it. But 2 kind of deal sweeteners that make its relationship with Zoom acquisition territory is, 1, they are a Zoom reseller, so they make money when schools buy Zoom. And that relationship makes them a formal partner of Zoom. And 2, the reason I'm writing about them now is that they raised a $16 million seed round, co-led by GSV and Emergence Capital. Emergence invested in Zoom. They also have investments from the guy who named Zoom, who is Jim Scheinman, and Bill Tai, who was Zoom's first investor. So very meta.
Very, very meta. So your bet here is that they have built essentially the educational Zoom variant on top of Zoom. And as a Zoom reseller, they're going to make Zoom money, themselves money. And so eventually Zoom's going to be like, well, we'll just tuck that into our overall platform.
Yeah. Furthermore, like I asked Michael and I was like, well, one way to avoid in case Zoom changes its mood, like Twitter notoriously did and kind of wiped out a ton of apps. Are you trying to build on Blue Jeans or Hangouts or whatever? And he was like, no need.
As a reminder, Blue Jeans is now owned by our parent company, Verizon.
And as a second,
we've now checked our box for including a product placement from our parent company.
And as a second reminder, Emergence Capital backed Crunchbase, where Natasha and I used to work. Not that matters, but if we're doing disclosures while we're here.
Fine. Bill Ty used to be a colleague of mine at Sierra City, so we're all conflicted.
All right, I actually built GSV Ventures headquarters by breaking with my hand.
And we are using Zoom right now, and we are dependent on Zoom to record equity. So our life is going to be ruled by all of these people.
Natasha, do you see this product getting actual wide kind of market uptake? Do you think that schools are really going to use this? Is it affordable? I mean, it's cool, but to me, it's a cool product. I don't know how it's doing kind of out there in the world.
My biggest problem with this company is that right now it's only usable for people who have Macs. Any student can kind of still tune into the class, but it only gets that really strong capabilities like the formatting and the toggling between screens and live testing in the way that ClassEDU is selling itself if you have a Mac. And so Michael said that the 16 million will be used to working on Chromebooks, which is the low income, most accessible type of computer out there. It's like kind of your minimum viable product. It's usually where people start. And so, yeah, its success will 100% depend on if it moves past the Mac.
Okay. I'm surprised they're not going to Windows next, given that I think more teachers have Windows-based PCs than Chromebooks. And I own a Chromebook and it's garbage. Anyways, one thing we've all been doing, it's fine. It's a little netbook. It doesn't do anything. It's not a teaching device. It's just
it is most accessible, though.
Device.
So I feel like it's going to be doing Windows, but I think the most accessible and the thing that I was like, I want to see this happen is Chromebooks, because those are the ones that like IBM and Google are donating to people that can't afford their own computer. And so
yeah, it's one way to win hearts and minds is just to have a huge lost leader called giving stuff away. All right. Yeah. One thing we've done during the pandemic, or at least I've done during the pandemic, is do a lot of book clubs. I'm in, I think, 3 at the moment. And it's been super invigorating to like have people with whom I get to read and kind of push me in new reading directions. And there's a startup called BookClub, Natasha, that raised $6 million that you wrote about today, I think. So tell us what's going on and why does a book club need money?
Yeah. Well, actually, let me first ask you guys a question. What are the favorite, I know both of you are crazy readers. What is kind of your favorite use case of a book club? Like, what's the biggest benefit of doing a book club, if at all, in your heads? Danny, you start. I'm really curious.
I think book clubs exist to remind you that there's way too much to read and you should never read with other people. Because
do you enjoy the discussion at all?
First of all, I've never had a book club successfully come together with more than 3 people in which everyone's actually read the book and has actually thought about what the book means.
Dude, you
book clubs always fail because of the marginal. I try to upgrade, but at the same time, like the reality is, there's just so much content. There's so many books. There's so many things to do. You read one book, and guess what? Everyone else read something else because they got distracted or whatever, and it's very hard to centralize everyone on one topic. But Alex, what about your experience?
Much more positive than yours. I mean, for example, one thing that I like about book clubs is that they have a way of dragging me in new directions. And so I'm in a book club with actually a bunch of people from my area, of whom I'm the only man. And so the books that get selected by that group probably aren't the things that I would think of first. And so they've dragged me in new directions. I've read books that I wouldn't otherwise have picked off the shelf, and they've diversified not only my author base, but also just what I've been reading into. And it's been super mentally worth it. So for me, it's the diversification, and also it adds some rigor. So I read a lot of stuff for fun, and it makes me have some other stuff on a more regular cadence. And so I find that to be just useful to make sure I don't fall behind a certain kind of like overall pace of reading.
Yeah. I mean, I'll add my take and then I'll introduce what book club is up to. I am part of one, and we have obviously struggled during the pandemic a little bit. Like wine and cheese kind of brought us together to talk about books all the time, and we don't do that anymore. But it definitely gave like a second life to a lot of the chapters and books I read when I was reading them. We were reading Educated, which everyone had talked about, and there was so much content out there, but still sitting with people and just breaking down a quote for 20 minutes felt like a very cool version of English class. And so it made me more incentivized to read. But I'll stop talking about book clubs to talk about Book Club, a new startup that just raised $6 million in seed financing to basically create a masterclass-esque experience with authors to engage with our book clubs. So let's say we're reading a book by Jhumpa Lahiri. She can come into our book club. We can request for her to join us, or we can, pull up a video on a question we have that she has already answered and kind of integrated into our book club. It's kind of creating like the way that the co-founder David Blake described it is taking authors from kind of like behind the book to part of your experience.
I've been reading William Dershowitz's The Death of the Artist the last week or two, which came out in July. And one of the things he really emphasized in the writing section of the art book is that, book tours were not a thing until the 90s. And today, an author on average will do something like 90 to 100 in-person engagements to sell their book as part of a kind of a big, any kind of large publisher book tour. And so to me, what's interesting here is the ability to actually scale. The book tour is not very scalable. It's actually miserable. Almost all authors will complain bitterly about the book tour. And in fact, Zoom has been one of the best things that's ever happened to the book tour because you can stay at home and actually do writing and do the work of an author as opposed to moving in your jalopy from Holiday Inn to Holiday Inn Express across the great United States. And so I actually think there's a huge opportunity to bring in the way that Masterclass brought high quality production values, consistency, and sort of an aspirational tone to books, right? So even something like The Odyssey, I have Emily Watson's copy, hopefully coming up. That's another one of those book clubs that's like 5 years ago that never actually happened. But I could imagine if she came on the book club and had a 2-hour engagement with high quality production values, it's a way to like bring out the quality of the work that you're reading. And to me, that's really exciting. Now, how that makes money and whether it should have $6 million of seed funding, that's an interesting question, given that I feel like there's so many book focused platforms that have tried to get built over the last couple of years that have just not been successful. Everything from Goodreads, which sort of got miserably bought by Amazon, has never really been improved since, and onward. So it'll be interesting to see how they perform.
I can see the market for it though, because
I can see the
often,
market, yeah.
like if I want to get N.K. Jemisin to show up, I presume it's gonna be very, very hard because she's a freaking superstar. But like there are authors that I read who are smaller, whose books probably sell less, and I would definitely pay. Just thinking like out loud about money, which is always a little weird, but like if we read a book for book club and I could bring an author for like $200 for like half an hour and like have them like talk to us about the book and like answer our questions, I think I would definitely do that a couple times a year, just because I love that kind of like being able to talk to the source material person. So I can see a lot of demand for this. The margins could be okay for book club itself. I just wonder how many nerds out there are like me, I guess.
Well, I was talking to him and he was saying, the co-founder, and he was saying that a lot of their success will depend on getting those big aspirational names on the platform first, similar to Masterclass having, Serena Williams or what's his face, the crazy cook.
Oh, Shouty Man.
Shouty Man was problematic. So
Shouty Man, bad hair, terrible television. Danny, you're the pop culture expert. Help us out here.
Gordon Ramsay.
Gordon Ramsay.
Gordon Ramsay.
I'm so glad we don't remember him.
Contribution right there.
But yeah, so that success will be related to that. And they're going to do something similar to Masterclass again with they charge a subscription fee. So it'll definitely be for like bookworms versus people who kind of have the one-off experience.
I would like to point out that everyone in the audience now knows we have good taste. Because no one actually knew who Gordon Ramsay was. Except
I can name a lot more authors
Guy
than celebrity
Fieri also exists, but thankfully we don't know about that. The subscription will be interesting, right? So I think the question, this is what always I think harms a lot of book clubs is it's the continuation, right? It's easy to do monthly or maybe quarterly. It's hard to keep people engaged over a long period of time because of work and everything. So maybe the right structure, keeping people up to date so that they know, gee, the author's going to be here. I'm going to be embarrassed if I don't read this book. I want to ask something completely stupid. So maybe that'll be a great accountability mechanism.
And finally, if you said if you subscribe to this, you can talk to John Scalzi or watch John Scalzi talk about his books every couple of months. I would, I read all the stuff that he writes lately. So to me, I'm a fan of him as I am of like a band. It's like that. This hits me in all the right spots.
I'm going to end with one last thing that I think people should start looking at is I've been hearing I heard talk to two pre-seed early stage founders in edtech this week. There's definitely the version with Class for Zoom that is like, we are Zoom, but better. And then there's the version of BookClub that's like, actually, we don't want to be anywhere near Zoom. And so I think we're seeing like the divide of like edtech that's like, we're going to live on top of Zoom and just admit it. And we're going to see the version of edtech that's like, we're going to compete with what you think you deserve versus what you actually deserve.
I mean, all that sounds great because it gives us options, and options are good as a consumer. I love competition. I love seeing people try out new things. Speaking of people trying out new things, guys, we have to talk about kind of the fintech world, which has seen a lot of money and change in the last couple of years, giving consumers more options with what to do with their money, including things like Robinhood that let people trade for free across crypto, equities, and options. And of course, Chime, which brought kind of a no-fee neobank to the world, into the US market to a big degree. The big news this week is that Robinhood raised more money. And this is the fourth time I've had to say that this year because they've raised 2 mega rounds of 2 tranches apiece. And the news this week is that they added $460 million to their Series G, which was only $200 million before. Maybe that should have been a hint to us that more money was coming. But they're now, their Series G is $660 million at an $11.7 billion post-money valuation. Whew. And that was on top of its preceding quite large, I believe, $600 million Series F from earlier this year. So that's the Robinhood news. Also, inside the last week or maybe 8 days, Chime added $485 million at a $14.5 billion valuation, claiming EBITDA profitability. So what we have seen in the last 12 months is Chime and Robinhood raised a combined $2 billion plus. And that seemed to me like a milestone in consumer-facing fintech. And I wanted to just talk about it because the Robinhood effect is real, I think, to some degree, Danny. So when you heard about all this new money for Robinhood, first impressions, what were you thinking?
I mean, I think it's a reminder. I mean, yes, we actually talked about the last round and the lack of dilution at the time, if you remember, on equity. This is not uncommon as you get to later stages where there are investors. It could be pension funds, it could be insurance companies who just need more time to write checks, right? So my guess is they had someone in mind. Total speculation here, but I can imagine there's someone who needs a 6-month lead time to write a multi-$100 million check. And so you write the round, you do a first close with the money from the VCs who are much faster. But then your insurers, your pension funds, and others who need a lot more diligence time, they have to do a lot more work. They're leaving space for them basically on the cap table. So my assumption is it wasn't a sort of random decision. It wasn't like an extension round that came at the last minute. It's actually money that probably was already agreed to months ago with the last round. And look, it's a sign that the company is just doing, adamantly well. Like, I mean, it is now broken through much in the way that we were just talking about Zoom. It is broken through into pop culture. It is a more consumer-focused app than Zoom. I mean, who would have thought that an enterprise video conferencing SaaS app would become a verb? But ironically, Robinhood hasn't verbed, right? You don't Robinhood your stocks or something like that. At least I haven't used it as a verb.
You YOLO those call options is what
you Wall Street bet it all the way to the moon. But I think it's also a sign that there's still a lot of potential for Robinhood.
I think there is. And I wonder, sorry, Natasha, please.
I was just going to ask kind of what you guys think is next for Robinhood. I saw in your story, Alex, that Chime is IPO ready kind of within a year's time. But what does Robinhood say about that?
It's a really good question. I think what we have a good idea about with Robinhood is how fast its revenue is scaling. What we don't know is how good of a business it currently is. Like, I don't think we know their gross margins. I don't think we know their kind of current operating margins. There's a lot of questions. So it's very hard to say IPO ready or not. Like with Chime, we know EBITDA profitable. And I clarified with them, it's not adjusted EBITDA positive. It's pure EBITDA positivity, which matters. They're not ripping out share-based comp from that. So we know that Chime is effectively very rich, has about $1 billion in cash, can go public whenever it wants. It's going to wait a year. Fine. Robinhood, more of a question. But if you go back to Q2, their payment for order flow revenue alone was around $180 million, which put them on, Danny, like about $700 million plus.
Is this Robinhood or Chime?
Robinhood, sorry.
Okay.
So Robinhood, we knew that in Q2. They have other incomes as well. So they probably did north of $200 million in revenue in Q2, putting them on an $800 million plus run rate at the point. More capital comes in, they can expand further, things look great. My question is, does the trading boom dissipate at some point? And if so, how much does that hurt them? That's my question. But to me, Robinhood is at least big enough, Natasha, to go public. The question is, are they profitable enough? And I don't know the answer to that.
And then I think on Chime, I mean, one of the dynamics you see in 2020, for all these neobanks is, the incumbents are just getting eviscerated. I mean, you can look at some of the market caps for some of the traditional incumbent banks, but look, the brick and mortar retail bank with thousands of locations in expensive retail corridors in this environment where a lot of folks can't even go outside of their homes is quite possibly the worst business model you could have for a bank today. And so for a Chime to come in, which is app-based, which you can do at home, you can run transactions. Chime's whole model is supposedly feeless, which is debatable, but like that's sort of their models to reduce a lot of the fees for financial services, mostly because they have that efficiency. They don't have the retail banks. A lot of things are automated. And, to me, like a lot of these neobanks are just going to come into their own in the next couple of years. It's not online banking has been a thing for literally 20 years. But nowadays, with the infrastructure in place, there's real scale there. And I think Chime's going to be one of the first out of the gate.
So I wrote a story about this kind of collection of funding rounds and impacts. And I went back through what we kind of know about Chime's revenue growth. And if you go back to stories written in November and December of last year, people were saying 200 million in revenue for the year or 300 million in revenue for the year. Well, Chime told us, Danny, to your point about the success of this model, that they've grown transaction volume and revenue, top line, by 3x this year. So if it was 200 million last year, it's about 600 million this year. If it was 300 million last year, it's about 900 million this year. Those are legit numbers. That's not just save that's not screwing around. That's, rather impressive. So these two companies that have now reached decacorn valuations are not priced at insane revenue multiples like Snowflake was post IPO. They're actually somewhat reasonable. And then the question becomes margins, profitability, and IPO timing. So very exciting stuff. We will see them soon.
And one of the interesting dynamics I learned today, I wrote a funding story, which we're not going to talk about for a lot, about Petal, which is a consumer credit card built around cash flow instead of traditional credit scores. But one of the things that actually came out of that conversation, they raised $57 million from Valar Ventures, their third time that Valar has tripled down the company, was that credit scores have actually increased this year. And the reason is because the government's direct injection of money and funding to individual taxpayers, people paid off their debt. Actually, debt has been massively paid off in the last 6 months. And so for a lot of these banks, if you suddenly get $2,600 in the mail, where do you put it? That's actually been a huge issue for a lot of folks. Banks were closed when those checks were written. And so they had to find ways to create direct deposit accounts. And so it wouldn't surprise me if Chime got a huge boost from the surplus checks. And not only that, like because of the automation, the scale, their expenses did not grow linearly with the transaction volume and the revenue growth. And that's why you're starting to see this EBITDA positive sort of margin there. And that means, as far as I'm concerned, they're ready to go public. Like they're ready to, this could be a SPAC next week. Who knows?
Danny,
there's a lot of fintech SPACs. So, in fact, I think we've talked about it, but, there's at least like 8 or 9 fintech SPACs ready to go. So it would not surprise me at all if a company like this is the one to go.
I was just going to add too, like when I compare fintech and edtech's boom, I can't believe I'm saying this, but I feel like I believe more in fintech's boom because unlike edtech, people are definitely expecting a decline there's going to be the decline in users when things reopen. I feel like with banks and with money, it's just so much more sticky that that's not going to happen at the same level. I just see so many edtech companies completely losing people the moment things reopen. They'll keep some of that growth, but something about Robinhood and Chime's growth of new customers during this time feels a little less hard to erase.
I would stack it Chime at the highest because people don't tend to change banks. I did that last year and it was miserable. And then I would say Robinhood number 2, and then I would EdTech in the lower, lower bucket. But with some caveats, like if trading volume drops by half and everyone runs out of money, like Robinhood's hosed. But I mean, probably won't happen, but we'll see. We need to do a hard pivot into the world of Femtech, which is a controversial phrase describing a part of the startup and technology space that Natasha wanted to quibble with. And I think it's a good point. So I want to hear you out, Natasha, on why Femtech is a crap phrase that we should probably not use. Say that very carefully.
Femtech.
What did I say?
It sounds like fintech a little bit.
Oh, sorry,
from fintech. So
sorry, fem.
From fintech to femtech.
Yes. So I apologize that I sound like a drunken sailor shooting for whales. Femtech, not fintech. Natasha, please.
Yeah, I mean, I think femtech is the wrong term for a couple reasons. One, people use the term to describe just products that women use versus women health products, which is problematic. Like for example, Revel is a company that helps elder women bond with each other and create experiences. they are not a women's health product, but just because they focus on women, people are saying that they're a femtech company, which is a problem. Also, the term kind of discounts the trans experience, people who don't identify in the femme category, but are an addressable customer in the category that people are using. I think that it's just an exclusive term, and I hate it so much. And I don't think that I'm having a lot of struggles with thinking of companies off the whim right now. But I think with like Roe, for example, we don't hear, man tech or male tech. And I don't think we need to unnecessarily genderize a sector of technology.
No, I agree with all that. But in this case, we do have a company that raised money that is aimed at women. It's called Willow. It does wearable breast pumps. It's raised $55 million. And this is on the agenda today because our producer, who has children, raves about this product. And so it gets a in-house endorsement for being usable. And $55 million led by NEA and Meritech Denny is always going to catch our attention, including they've raised a bunch of money total, I think, right?
They've raised $155 million in total. And, I had no idea about this space because I don't have kids. So it's not something I have to think about on a day-to-day basis. But apparently, Willow joins Naya Health, Medela, Lacino, and a bunch of other companies that are trying to make breast pumping much more efficient and comfortable. I mean, one of the things that Willow's sort of two major innovations, according to them, are one, it's cordless, so you can wear it on the go, so you're not restricted. You don't have to sit and pump, was their language. You can go and pump. You can run and pump. Which presumably allows you to be a little more efficient given, the kids are at home, school's closed, and a lot of things are going on. And then they also emphasize unique suction. And I got to be honest, like when I read this, I was thinking about that advertisement from Oric years ago about, or Dyson, about their unique suction vacuum cleaners. But what they argue is that you really need to have the right properties of suction in order to pull the milk out of the breast. You can tell how much I know about this, by the way. It really helps to have a husband to figure these sorts of products out. You're literally talking to the person. It's like asking me a pop culture question. But if you get the suction right, then the milk comes out of the breast much more easily, and therefore it's a higher quality product. That's the argument for Willow. Clearly, it's selling to VCs because they've raised a lot of money.
And hardware is freaking expensive. I know a ton of companies that have shut down in the space. I know Moxley got acquired by Medela, but then kind of got tossed to the side. And I feel like that's probably why we're seeing a breast pump company raise so much money, is the costs are probably very high.
Hardware is always hard, right? Hardware is always expensive. But the thing I think we've learned, particularly in the exercise space the last couple of weeks with Peloton, Mirror, and we've talked about some others who have joined that space is, people will pay for high quality products. I mean, I might joke about Dyson and suction, but the reality is that, you breast pump every day. It's a common thing. It's actually quite painful. And so if you can actually have a much more comfortable product that's much more convenient, I don't know how much, do we know how much Willow's product costs?
I was just about to say about $500.
It's a $500 product, which sounds like a lot, but you're going to breastfeed for, potentially a year or two. And even beyond that, if you have multiple kids, you'll reuse it. So to me, it's an easy argument for an investment. It's a couple of pennies a day for you. So it makes total sense if this is something that's helpful for you.
And Moxley's product was something around $80. So maybe $500 is the better price point to stay afloat.
There's got to be better margins baked into that dollar amount. With $500, you can have some real margins. $80 is really thin.
Well, you can have a high quality product. The alternative, of course, is just a manual pump, right? And so when you're at $80, it doesn't make a huge difference that it's worth actually spending that.
The question is how many new moms can afford $500? I don't know. I've given up trying to understand where the U.S. economy is in the coronavirus era because people seem to have either no money at all or a helicopter. So it's hard for me to tell where that lands.
But how many mothers are worth $500?
Every single one.
Priceless.
There you go.
Priceless. Thanks. Hopefully my mom hears me from upstairs.
Talking about things that may or may not be as priceless, VC media, which is one of our favorite topics. As someone who, we all cover the VC industry quite a bit. But there have just been so many new initiatives and brands and media and news that we just kind of wanted to bollocks it up to all together into one group. So the first thing here, I didn't even watch this, so I regret being, again, misinformed about everything in the world. Is Prime Time VC. Alex, I think, or Natasha, you watched this. What were your thoughts?
We've both seen it, yeah.
Yeah, it felt like,
So what is it? Because I haven't seen it.
So it's not a game show, but it is a game show, according to the creators. Basically, 4 VCs come on. They debate on the hottest topics of the week, like TikTok, YC's demo day, Snowflake, IPO. While doing so, because they're not on equity, but they're on a show that's about VCs, they can bring in their portfolio companies and mention that as kind of what gives me the right to talk about this. And the winner gets to do a monologue for 30 to 45 seconds at the end. Can be about a company, can be about innovation, et cetera, et cetera. It has sponsorships.
I don't think this is going to work out well. I mean, last week we did a live equity episode from Disrupt with 2 or 3 dozen VCs in the room, and no one signed up for trivia night. And I had to pretend like I was a VC again.
If we give the incentive and we're not, I think we're not we're a little snippy, and I don't think that Primetime VC was snippy. I urge people, I urge Danny to watch it, and I really want his take on it at the next
We'll compete with daytime soap TV. But okay, so there's Primetime VC. And then we have, Alex wants to have a comment.
Look, there's a reason why we've never really done more than one guest on the show to keep the host to guest ratio very high. It's because a lot of VCs, not very funny. So I'll leave it there.
I was going to say, I'm happy there's a home for everyone. For people who want to watch VCs debate each other, do it. It's their tagline deserves a snap. It's called the show of accredited banter.
All right, 2 points for that. So, podcasting is a big darn deal around the world. And as a non-podcast consumer, mostly, it's always been a bit of an enigma to me. But what we've seen is the rise of kind of micro media brands attached to non-traditional companies. And Andreessen, of course, is no slouch here. They've had a podcast that I'm sure you've heard of. Now they're doing a bunch more. They started podcasting back in 2014. So this is a long time coming. And about a year ago, they launched a show called 16 Minutes. It was, shockingly enough, about 16 minutes in length. Call it the Millennial 60 Minutes. Anyways, they're about 40 eps in now, and they're going to go ahead and keep doing that. They found kind of product market fit, they claim, with the show. And so I think this matters not much that Andreessen's doing a thing with podcasts and doing more of them, but it just goes to show that VC firms, once a capital repository with a couple of people and some assistants, have become full service firms, and now also to some degree media companies. So we're seeing the agglomerization or the blobberization of VC into more and more areas, trying to do thought leadership, trying to build their brand, trying to get deal access and deal flow. It's a very competitive space, and money is no longer anything close to sufficient to get into the best deals. So I'm not surprised by this. I'm not going to listen to it, but that's where I stand.
That's rude. Go ahead, Josh.
I was going to say, the person who launched the 16 Minutes podcast is Sonal Chokshi, who's great. She's really good at her job, and she's an interesting human. I recommend following her on Twitter. I was excited to see kind of a network being formed within Andreessen. Excited might be a strong word, but it's cool to see that bet happening, to your point, Alex. I think it's more than a one-off. I think a lot of VCs have admitted to me off the record that we do a podcast. It's not great, but we need to do it just so we can say we did one. And so I'm always here for people who are actually going to try and not just do something easy.
Why do they need to do a podcast? I don't understand that. Someone explain that.
Why do I need to do a podcast? Why am I
because it's part of your job. You don't count. Why do VCs need to do a podcast?
I guess just your personal brand, dare I say. And so it's an easy way to riff and be another way that people end up in your inbox is probably the reason. I don't know.
The number of VCs that are sufficiently interesting as to kind of consistently draw our attention are people like, Tamaz Tungas from Redpoint, who runs a great blog on kind of the SaaS space, and he's fantastic. Are most people in the VC world sufficiently interesting as to be podcast material? Most journalists aren't. But we're being honest, so I'm not trying to be rude to VCs.
I appreciate that, Alex. I agree. I think there's the running joke of you don't have to Substack post everything. You can just tweet about it, or you can just not say it to anyone. Every one of your ideas is not worth a Substack post or an article.
I keep saying all I want is a mute button for the whole world. It really helps a lot.
That's called vodka.
That's I think it's mezcal over here, but it works nonetheless. And then finally, we had a break, news this week that Casey Newton, who's been a longtime writer at The Verge, writes the Interface newsletter, has written hundreds of editions covering the platforms, Facebook, Instagram, the whole 9 yards, is leaving The Verge to launch on Substack, which got quite a bit of attention, I think, in the industry. I mean, that was basically my Twitter feed all day yesterday, was people debating the future of email newsletters, Substack, the future of media. I thought it was a bold bet. I hope he succeeds. He has the newsletter is going to launch next month I think it's called The Platformer. Might be getting that wrong. I don't think it's just the platform. It's the Platformer.
Yes.
And you can sign up on Substack. So, I mean, another person going into the Substack universe, it's getting lonely out here in big corporate media world.
I was listening to Casey talk about this on Clubhouse yesterday, and he mentioned.
Oh God.
Actually,
I'm so glad you did. I'm sorry. Tell us what he said.
So yeah, I'll make fun of myself for being on Clubhouse. I don't have any hot take on it, which is why I haven't blogged about it or brought it up, because I didn't want to get roasted by anyone on this equity team. But no, he was talking about how he already has several hundreds of subscribers that are willing to pay in one day. And I think that was a nice thing to hear and see. Also, he has a mystery tier, which is you can pay kind of as much as you want, which was also cool. And he said a couple of people have bit that way too. And so, I don't know. I'm always going to support a journalist making money.
Yeah. I mean, this is, so to be clear to everyone listening to the show, like, I think a great chunk of journalists who currently work for big media have their eye on what Casey is doing, on what Alex K from BuzzFeed News is doing, which is setting out on their own. One of the most compelling things that Casey Newton said in his, I forget if this was the Twitter storm or the post that I read or whatever the hell. He said there's uncapped upside. You know, a media company is going to never pay you more than X, right? So you can't ever make more than that. But if you build your own pub and it goes well, which for most people it won't, 'cause it's going to be kind of a niche thing and so forth, but like, it can, in fact, make you a lot more money. Everyone wants to be Ben Thompson from Steckery. Everyone wants to make that kind of money. One person does. Maybe the answer will be 7 people that can do it. I'm not surprised that Casey is doing this, given his personal brand and his newsletter that's done so well, and also the fact that he's just lovely. He's very, very smart. He's a lovely person, and people like him a lot. So it's a great combination of things.
He is lovely. And but that said, you know, Ben, Casey, and Alex are all white guys. And I think that the access on who can start an email newsletter is something we should all continue to track. I tweeted at Substack yesterday asking them for their diversity metrics. Have not heard back yet.
Yeah, you're not going to hear back from that for a while.
Casey mentioned in his Twitter thread that he is going to start kind of helping shadow other newsletter writers that come from underrepresented backgrounds, which could be great, but would love to just see it actually happen too and see like money go towards getting those writers to move on to this platform if that's something they want to do.
Yeah, I think we're going to see more and more of this as time goes along, especially if the email subscription boom continues. I don't think it will, because email is terrible, but I think it was a great hack to get some people independent. And with that, that's our show. 2 of us will be back next week, and it won't be me. Bye.